Ever wondered how stock traders make decisions about when to buy or sell? They often use a method called technical analysis. This approach relies on the study of statistical trends gathered from trading activity. This includes factors like price movement and volume. The key idea here is not about forecasting the future, but rather spotting potential trading opportunities based on these trends. Think of it like weather forecasting. Meteorologists can't predict exactly when it will rain, but they can identify conditions that might lead to rain. Similarly, technical analysts don't claim to know exactly when a stock's price will rise or fall. Instead, they look for patterns and trends that suggest a potential change in price. This method of analysis provides a framework for making educated guesses about future price movements. It's a way of making sense of the market's often chaotic behavior. Understanding technical analysis can provide you with the tools to make more informed trading decisions. So, how do you get started with learning technical analysis? First and foremost, grasp the basic financial concepts. These are the building blocks that'll help you understand the complex world of technical analysis. Remember, the stock market isn't a game of chance, but a field that requires a strong foundation in financial knowledge. Now let's talk about risk. Trading, by its very nature, involves risk. It's about predicting future price movements, and as you might have guessed, the future is never certain. Therefore, understanding risk management principles is crucial. Never risk more than you can afford to lose. Next, you'll need to get comfortable with stock charts and trading volumes. Stock charts are like the pulse of the stock market. They tell you the story of a stock's performance over time. Trading volumes, on the other hand, give you an idea of the strength behind a price move. High volume often suggests a strong consensus about the value of a stock. Finally, you'll want to familiarize yourself with different types of technical indicators. These are tools that traders use to make predictions about the future direction of a stock's price. Some common ones include moving averages, relative strength index, and Bollinger Bands. To become proficient in technical analysis, start with the basics and build your knowledge progressively. Once you've mastered the basics, it's time to delve deeper. As we venture further into the realm of technical analysis, we begin to encounter different types of indicators and patterns. These tools are not meant to be intimidating, but rather, they're like signposts guiding us through the financial landscape. Let's think about it this way. Imagine you're an explorer navigating uncharted territory. You have a map that shows you the lay of the land, hills, valleys, rivers. This is akin to a stock chart. Now, you've also got a compass to help you find your direction. This is like your technical indicator. And then there are patterns, the footprints left behind by other explorers, or in our case, traders. These patterns can often give us clues about what might happen next. Now, one of the most vital concepts in technical analysis is the idea of support and resistance. Imagine you're bouncing a ball. The ground where the ball bounces back is the support, and the height the ball reaches before falling back down is the resistance. In the same way, support in trading is a price level where buyers tend to enter the market, pushing prices up, while resistance is a price level where sellers start selling off, pushing prices down. Understanding these concepts can be crucial in predicting future price movements. But let's not forget about market psychology. It's like the weather changing the conditions of our exploration. Market psychology reflects the overall sentiment or feeling of investors, and it can significantly influence price movements. Fear, greed, excitement, disappointment. All these emotions play a part in the market's behavior. When investors are optimistic, they buy, driving prices up. When they're pessimistic, they sell, causing prices to fall. Recognizing these emotional shifts can give us an edge in interpreting market movements. So as we delve deeper into technical analysis, we're not just learning about numbers and charts. We're learning to understand the heartbeat of the market, to listen to its rhythm, and to anticipate its next move. The more you learn about technical analysis, the more you'll understand the factors that drive market movements. Learning about technical analysis is one thing, but how do you put it into practice? Well, the first step is practice, but not with real money, of course. We're talking about paper trading. Essentially, paper trading is a risk-free way to practice your trading strategies in a simulated market environment. It's the perfect sandbox to test your theories, strategies, and intuition without the fear of losing real money. Now let's talk about your trading plan. In the world of trading, it's not just about recognizing patterns and making predictions, it's about discipline and consistency. This is where your trading plan comes into play. It's a blueprint for your trading activity, a guide that outlines your financial goals, risk tolerance, methodology, and evaluation criteria. Stick to your plan and adjust it as you grow and learn. And speaking of learning, a trading journal is your best friend. It's a record of all your trades, thoughts, and observations. A trading journal helps you learn from both your successes and your mistakes. It's a tool of reflection, a way to understand your thought processes and decision-making patterns. With a trading journal, every trade is a lesson, and every lesson brings you one step closer to becoming a successful trader. Remember, practice makes perfect. The more you practice technical analysis, the more comfortable you'll become with it. And the more comfortable you are, the better decisions you'll make. Practicing technical analysis is crucial to becoming a successful trader. So, what have we learned about getting started with technical analysis? Well, we've discovered that the journey begins with understanding the essentials. Grasping the basics such as chart patterns, volume, and trend lines is the foundation of technical analysis. We've also learned about the significance of technical indicators like moving averages, MACD, and RSI, which can provide valuable insights into market trends. We've delved into the importance of practice, particularly through paper trading. It's a risk-free way to test theories and strategies, a crucial stepping stone in the journey to becoming a proficient trader. But remember, the world of trading is dynamic, ever-changing. Continuous learning and adaptation are critical. It's about staying curious, staying hungry. This is not a one-and-done deal. It's a lifelong pursuit of knowledge and skill. With determination and the right approach, anyone can learn technical analysis and use it to make more informed trading decisions.